Investors want attractive opportunities. That's no secret. But when you watch how many of them evaluate deals, a lot of them are still thinking in terms of businesses, not systems. And that shows up later in the results. I'm Justin Kaiser, CEO of Empire Franchising, and I've spent the last 25 years building, scaling, and investing in businesses, including taking my own franchise brand from zero to over 100 franchise territories in 3 years before an acquisition at the end of 2024. Now, one of the most consistent patterns that I've seen is this. Scalability isn't something that you add later. It's something that's either built into the structure from the beginning or it is not there at all. Because a business can perform well at a small scale. It can generate revenue. It can even grow for a period of time. But that doesn't mean it's designed to scale. And this is where investors misread opportunities. They see performance and assume scalability. But those are two very different things. Performance tells you what's happening now. Scalability tells you what happens when you increase the volume, when you push more demand through the system, when you try to expand faster. That's where the real test happens. Because if growth requires new processes every time, new decisions every time, new problem solving at each step, then the system isn't built for scale. It's built for operation. And operational businesses behave very differently when you introduce capital. They absorb it slowly. They require more oversight, and returns for investors become dependent on execution at each individual level. Now, contrast that with a system that's designed for scale from the beginning, where the process from lead to conversion, from onboarding to performance is defined, measured, and repeatable. Because when those pieces are in place, something changes. Growth becomes more predictable because you're not just guessing, you're executing. And when execution is consistent, capital deployment becomes more efficient. That's what investors are actually looking for. Not just growth, but growth that they can understand, growth that they can model out, growth that doesn't rely on constant intervention. This is where a lot of confusion comes in because businesses can hide inefficiency at small scale. They can compensate for gaps with effort, with intention, with founder involvement. But when you start to push, when you start to increase volume, those inefficiencies don't disappear. They multiply. That's when things slow down, margins compress, timelines stretch, and the experience of the investment changes completely. This is why two different businesses that look identical at small scale can produce completely different outcomes when capital is introduced, because one has a system that holds and the other relies on effort to maintain. Now, take that one step further and look at how this applies specifically to franchising, because franchising is often described as scalable by default, but that's not entirely accurate. The model allows for scale, but it doesn't guarantee it, because if the underlying system isn't tight, if the unit economics aren't consistent, if the sales process isn't controlled, if the onboarding experience varies from operator to operator, growth will expose those gaps. And when that happens, scaling creates more complexity instead of leverage. That's where a lot of franchisors run into problems, not because the concept doesn't work, but because the system wasn't designed to handle that volume. And investors feel that through slower returns, inconsistent performance, higher support requirements, and the need for more involvement than expected. Now, on the other side, when the system is built correctly, when lead generation is consistent, when conversion is predictable, when onboarding is structured, and support is repeatable, then growth starts to behave differently. It becomes a process, not an event. And when growth becomes a process, it can be scaled. That's where the model starts to produce the outcomes that people expect. This is where the shift happens for investors, because instead of asking, how does this work? They start asking, how well does this repeat? Because repeatability is what drives confidence, and confidence is what allows capital to be deployed at scale. Now, layer in something else that matters just as much, visibility, because scalable systems aren't just repeatable, they're measurable. You can track inputs, you can track conversion points, you can track timelines, and you can track performance across the entire system. That visibility allows for optimization because now you're not guessing what to improve. You can see it, you can isolate it, and you can refine it. And over time, That refinement compounds because each improvement increases efficiency, and each increase in efficiency improves the return profile of the system. That's how you move from growth to efficient growth. And efficient growth is what drives better valuations because it reduces uncertainty. And when uncertainty goes down, capital becomes more confident. When capital becomes more confident, it moves faster and at a larger scale. Now, I'm going to bring this back to how investors should start evaluating opportunities because this is where the biggest mistakes happen. Instead of focusing on what the business has done, focus on how the system behaves. Ask where the variation exists. Ask how repeatable each step is. Ask what happens when volume increases. Ask what breaks first, because every system has a breaking point at some point. And understanding where that is tells you everything you need to know about scalability. And over time, that shift evaluation changes outcomes. You're no longer reacting to results. You're anticipating how the system will perform under pressure. That's what allows you to deploy capital more effectively. And that's where consistency starts to show up. Consistency is what compounds. Now, let's take that one step further and think about what happens when you layer this across multiple systems, multiple brands, because this is where platforms start to separate. When you have a centralized infrastructure, when you have a consistent acquisition engine, when you have a repeatable onboarding process, every new brand that enters a system doesn't start from zero. It accelerates. It benefits from everything that's already been built. That creates a very different type of growth curve, one that improves over time instead of resetting. Now, this is where the real leverage starts to show up, not just in scaling one system, but in scaling the infrastructure itself. And that's exactly what sophisticated investors are actually looking for. Systems that get better as they grow, not systems that get heavier. So if you're looking at franchising or any scalable business model, don't assume that growth equals scalability. Look at the structure, look at the repeatability, look at the system behind the results, because that's what determines whether an opportunity can actually compound or whether it will require constant input just to maintain. If you're an investor looking to get involved in what we're building at Empire Franchising and want access to a platform designed to scale multiple brands with a proven growth engine, then reach out to us directly at empirefranchising.com. We can walk you through the model, structure, and how you can participate at the platform level.